Hey everyone, welcome to the Token Tax Last Minute Your Taxes Are Due AMA webinar. Can everyone hear me? Okay, perfect. So we've got questions that came in through our email, support@tokentax.co, or also via our Twitter @tokentax, or just via intercom via our site. But also feel free to ask questions in this chat, please. Or you can send them to Devin, who's helping broadcast this right now. All right. Let me see. Okay, so quick recap. Today is June 29th, so end of the month coming up tomorrow. And the IRS delayed your tax deadline until July 15th. So there's a few things that the IRS has done this year that will help people out. The first is delaying till July 15th, filing your actual return. Now, remember, if you file your return, you can wait until October 15th to file your return. If you file an extension, your tax payments will be due July 15th though. So either way, you should probably calculate it to decide whether or not you want to pay. Now, if you don't pay your taxes on time, but you filed, you only owe interest. You owe 0.5% interest per month. So from July 15th to October 15th, you could think about that about 2.5% for those 4 months, for those 3 months, sorry. And then for people that don't file the return though, and don't pay their taxes, there's a failure to file penalty of 5% of what you owe. In other words, it's 10 times larger than the monthly interest. So the really important thing here, just like last year, for those of you who are around with us, you need to make sure to file your extension by July 15th, even if you don't have the means to pay, or even if you still need more time to figure out your taxes. There's so much going on in the world, and it's definitely understandable, but make sure you at least file your extension on time, which is July 15th. And just like last year, for those of you who are filing with us, we will have an extension tool, so you can come give us your information. We'll try to get everything done in time, but we can definitely file an extension for anyone who's using the Token Tax full filing services, so you don't have to worry about it. Now, the second thing that's allowed for people who are struggling with liquidity is quarterly income taxes that you owe for 2020 taxes. Normally, you have to pay them March 15th, June 15th. Those have been suspended for now as well for 2020. So you don't need to be making estimated 2020 income tax payments yet if you don't have the funds. And one other thing I wanted to mention, just because we've been having so many conversations with people who need liquidity, is that the Pandemic Response Act has given a lot of flexibility to people to take money out of their IRAs or 401ks without penalties for those people who need money. And you can do loans to yourself for 3 years as long as you pay it back. And you can also, they've expanded the flexibility on removing money from those without having any 10% penalty or any taxes due right away. All right, so now let's get into crypto taxes. All right, so what's different for 2019 tax year versus 2018? So overall, the IRS gave additional guidance in October, but a lot of what they did was clarify things that they basically are saying retroactively they were true as well, such as forks should be reported as other income, should be reported as income that makes up the cost basis for when you sold that crypto. So a lot of people receive Bitcoin Cash, Bitcoin Gold back in 2017, and then they still haven't filed their taxes yet for 17, 18, 19. So people going back and doing that, you can make sure to do it correctly by having your forks and airdrops included. That's a big clarification that people didn't really realize historically, or it was unclear whether or not it was required. And they've said, okay, that clearly is required. there's been pushback. Another big area that I wanted to talk about was staking. I see, we just got a message in about staking. So staking is complicated. There's the Proof of Stake Alliance, POSA, and some entities in the space that are lobbying the IRS to try to get staking income to not be taxed as essentially as self-employment income or as mining income. In other words, right now, if you are doing a staking business, you have additional taxes compared to capital gains. And they're hoping that that's not the case, that they should be taxed as other income without the self-employment tax included. And so right now it's a big debate in the space. Some companies, and the IRS has clarified that staking income should be taxed as traditional income. Some companies are filing their tax return that way and then asking for a refund, or some individuals are filing their taxes the way the IRS is giving guidance and asking for a refund for part of the portion. And again, the Proof of Stake Alliance, there's some really smart professors and people in the space who have written really excellent pieces about why that should be the case and kind of the tax theory behind it. So that affects companies that are involved in staking, or individuals who have material amount of staking income. Tezos is a big one in that space. All right. So if anyone has any other questions, feel free to post them in the webinar. Otherwise, I'll just keep running through some other questions we had. Okay. So looking at the crypto tax basics, just taking one step back. There are two types of sales that require you to report your cryptocurrency taxes, to be very clear. If you sell crypto for dollars, or if you sell crypto for other crypto, you need to report. In other words, crypto to crypto trades are taxable events, and they always have been. The IRS has clarified. Also, if you spend crypto for goods or for a subscription or for anything online or for anything in real life, that counts as if you sold it for that US dollar amount, and you need to calculate the gain or loss, or you need token tax or some software to calculate the gain or loss. And the fourth thing is, if you pay a contractor, or you pay someone in crypto, or you pay an employee in crypto, you need to make sure to include that in their wages, withhold taxes, etc. And so all of those are taxable events, which also need to be reported on the 8949 gain loss report, where you calculate the difference between the crypto you bought or received and what it was worth when you either sold it for dollars, like I said, for crypto, sold it for goods or services, or you spent it to pay someone. Okay, so all of those are taxable events and need to be calculated. Someone asked about, if they are paid in crypto, how do they figure out what their tax owed is? And so what you need to do is get the raw transaction data of when you receive that crypto, and we'll figure out the US dollar equivalent of it, and that is the US dollar income you have from receiving that crypto. Okay, and then so let's say you received 1 Bitcoin today when it's worth $9,000. So your income is $9,000. Now you go and sell it in November. Hopefully Bitcoin's worth 20,000 at that time. And so you'll have an $11,000 gain. So you'll owe capital gains taxes on the $11,000 gain. So whatever your percentage is on that. Unfortunately, it would only be a short-term capital gain because you're selling it in November when you received it now in June. And then you would have $9,000 in ordinary income. So that's how it would be calculated. All right, let's see a couple other questions. Okay, one came in about FBARs and FATCAs. And so this is an important issue that I'd like to bring up, because we've seen a lot of misinformation out there about FBARs, FATCAs. What that is a foreign bank disclosure. FBAR goes to FinCEN, and the FATCA goes to the IRS. They have two different levels. So FBAR is essentially over $10,000 of value on any foreign bank account or any foreign exchange. Once you trigger that $10,000 threshold, you have to report every single one of your foreign exchanges and foreign accounts to FinCEN, Financial Crimes and Enforcement Network. If you don't, you can face penalties of the assets in the account, half the assets in the account. You can have a robo penalty of several $1,000s. So the key is this doesn't cost anything to report. There's no additional taxes. It's just a binary disclosure. Have you done it or not? So we really highly suggest that people do it. There were some articles published that said, oh, FBARs aren't required for crypto. But if you go to the source document from FinCEN, it's very clear. It says wallets do not require an FBAR to be filed. So if you have like a ledger or whatever, even if it's in another country, you don't have to file that. Decentralized exchanges, money on those also do not have to be filed in an FBAR. But conspicuous by its absence were all the other foreign exchanges, all the foreign exchanges like Binance, Bitstamp. Nothing was mentioned about those being exempt. And therefore, we think it's a better safe than sorry situation. Why risk it if you can easily just report what your max balance was on the exchange during that time? And the interest in this really spiked after Paul Manafort, Donald Trump's former campaign chairman. He got arrested. He was charged with many crimes. What he was actually found guilty of was not filing an FBAR for money that he was paid into foreign bank accounts. And that's actually why he's in prison now, or was in prison. So, it's something that is used as a hammer in certain situations. And after that happened, we had so many clients ask us, hey, can you make a report so we can file FBAR properly? At that time, it was pretty unclear whether or not it needed to be filed for crypto exchanges or not, because it was just such a gray area. It's not really a foreign bank account. But in the interim, with the clarification being sent out that said, hey, wallets and decentralized exchanges don't need to be filed, in my mind, it makes it pretty obvious that you should probably file foreign exchanges. But better safe than sorry. And then FBAR is the FATCA is the equivalent of that for your IRS tax return, your actual tax return. And that threshold is over $50,000. And again, if you have any questions on any of this, feel free to come to tokentax.co. Come to the bottom right of the screen. There's a little circle called Intercom Chat where you can chat with my team or I. Anyone can answer your questions about, hey, did I have to file an FBAR? Did I have to file a FATCA? Did I have any staking income? Let me take a look and see. And again, staking income and other income, it goes on a different part of the tax return, not the gain loss report. So those of you who are mining crypto, staking crypto, remember when you file your tax return or you have your accountant do it, or if Token Tax CPA is not doing it for you, you need to make sure that you're including your mining income as a Schedule C. You're including the income in the other places on your tax return where it goes. If all you've ever done is bought and sold crypto on Coinbase, you're okay with just the 8949, which calculates your gains and losses. Okay, so Thessie asked a question. Filing what's held over the amount for the FBAR or the actual amount. So the way a FBAR works is if you have $17,000 worth of crypto on Binance at any point during the year. So let's just say you had 2 Bitcoin and it's going up and down throughout the year. It hits a peak of 11,000 sometime in the summer. And so the max balance you had on Binance is 22,000. So that is what has to be reported to FinCEN or Binance. And then because you went over 22,000, when you went over the 10,000 on Binance, you have to go and see all your other foreign exchanges. And even if you only had $800 on Bitstamp, $1,000 on Huobi, you need to file an FBAR for each of those. And it's done in the same place. You just need to put the same identifying information, some information about the exchanges, or have an accountant do it for you. All of the Token Tax full filing plans, we do this for you completely. So you don't have to worry about it at all. And that's our bronze, our silver, our gold full filing. But those of you who are trying to file on your own or have your own CPA, make sure that they do this FBAR or that you do it for yourself on the FinCEN website. And if feel free to come to Token Tax and talk to us again via intercom if you need help with that. All right, so let's take a look at some of the next slides and misconceptions that we're still hearing about. So one thing that we'd like to mention is like-kind exchange. So again, some people in crypto, if you don't know what like-kind exchange is, it's when you trade one asset for another asset that's similar, that's a like-kind asset, often used in real estate. If you sell your vacation home in people who have second properties, they sell their vacation home in North Carolina, buy one in Florida, the gain on their house in North Carolina, you don't have to pay any taxes on it as long as you roll it into a new investment property. So a lot of people took this tax rule and used it for their crypto. Oh, okay, I traded one cryptocurrency for another through the end of 2017. And then the IRS clarified, hey, after 2017, like-kind exchange, it applies to real property, real assets, which in accounting parlance means real estate. But up to 2017, some people did file like-kind exchange, which deferred, gains and losses into future years, into 2018, 2019, 2020, whenever you sell your crypto. Some people made crypto to crypto trades in 2017 and are still holding their crypto, so those gains are still deferred if they did like-kind exchange. One important thing, though, is just doing like-kind exchange in your head is not acceptable with the IRS. You need to file what's called an 8824. Your intention to just do like-kind exchange, but then not put anything on your tax return, that's the incorrect way of doing it. You need to actually file what's called a Form 8824, which lays out, some metadata about the asset you sold and the asset you bought. And so again, I just want to drive this home because every week or every couple of days, we see someone, come to us who's like, oh yeah, in 2017, I did like-kind exchange. We go to look at their tax return and they have nothing on there. So they didn't actually file like-kind exchange. So now they just basically haven't filed. Now we have to go and figure out what the situation is. Are we going to amend 2017 for the like-kind exchange filings or for regular gain loss filings? So I just really want to drive home, it's not something, especially in cases where you had a lot of gains, you deferred them into the future. You need to make sure that you're using the correct information from what you reported in 2017 to make sure that eventually you're paying the right amount or you're reporting the right amount of gains. Okay, so if anyone has additional questions on like-kind exchange, again, it's kind of a complicated process where your gains and losses in 2017 and 2016 and 2015, the cost basis comes from the original purchase of Bitcoin or crypto with dollars. And every time you trade crypto to crypto, that original cost basis goes with the old crypto to the new crypto and is inherited by the new crypto. So you'll see weird things like, all right, I bought Ethereum back in 2016 for, $5, $10 in Ethereum. I use that to buy other cryptocurrency, but my cost basis is insanely low because, you bought Ethereum when it was $10 per ETH. Now it's over 200 or somewhere around there. And whatever crypto you bought is going to have that very low cost basis. So when you sell it now, you're going to have a gain. So especially for people that are doing tax loss harvesting who did like-kind exchange in the past, I know that's only a small subset of crypto investors, but it's really important that you get your taxes right because it's quite it's quite tricky. Okay, so jumping back to a little bit more straightforward. Okay, we got one other question. I reported crypto in 2017. Can I amend to so it depends on your intention. Like I said, a lot of people meant to file like-kind exchange. They didn't understand that. They just did it themselves in TurboTax, whatever. They didn't understand what that actually meant, that they had to fill in a certain tax form. They had to have the highest level of TurboTax. They had to do an 8824. So for those people, we amend and add the like-kind. And so Urban, it comes down to your intention of what you were planning to do in 2017. It's harder to say, oh, I filed with an 8949. Now I want to amend and change all my recognized gains and losses to deferred because now I understand how that works. Because it's more about your intention at that time. But you can come in, that's kind of a custom situation. We need to look at your data, at what you filed, at what you included, and find out what's the right solution. And realistically, it's a lot more work and a lot more difficult to file like-kind exchange. So you'd need to look at the pros and cons and the benefits. And again, it's not like a guaranteed thing that doing like-kind is fine. Again, some people in crypto did file it that way, but the IRS has never given clear guidance that it was fine or that it wasn't fine. They've said, we're going to take it on a case-by-case basis and look at everyone who applies. at every tax return individually. So the worst case scenario would be the IRS hits you with an additional penalty and says, no, we don't accept your like-kind filing treatment. We are gonna, you owe this tax plus a penalty plus interest for the back 3-4 years, whatever it is. And so you can do so what's called a statement of uncertain tax position. You basically shine a light on this and say, hey, IRS, we think that it's okay for these reasons. This is our rationale. But we want to just let you know to make sure that since there was no clear guidance given, we just want to be 100% certain. And so that is often a way to mitigate penalties. But again, it's not like a bulletproof, hey, why wouldn't everyone do that if people are saving money? So, we want to go through the pros and cons with people, but we've gotten so many questions about like kind that I thought I would bring it up. Okay, and then looking at some other issues, losing crypto, people who have had crypto stolen, hacked, people that lost money in fraud or scam ICOs. There are ways to get a deduction for that. Specifically, let's say you bought in for a token that you never received, or that came and now it's totally worthless. The project's gone, the developers are gone, the token's worth nothing. So you can write that off as a worthless security. And by convention, that would be written off at the end of the year. It's essentially like you sell it for $0. It's the same for stocks. Like if you buy a stock that goes bankrupt, you can write it off as a worthless security by convention again on the last day of the tax year. But what you don't want to do is write off crypto that isn't actually bankrupt, or write off a crypto project that isn't actually gone yet. All right, so that's one aspect. Another thing is that casualty losses for individuals have been removed from the tax code after 2018. So in other words, it used to be an itemizable deduction. If your car got stolen, if you had a lot of jewelry, it got stolen, if you had a casualty loss, you could deduct it from your taxes and get some benefit. And they got rid of that when they made the big tax cut changes. When they cut the corporate tax rate, they had to balance out the cuts with cuts elsewhere. So they got rid of certain things like itemizing deductions. They capped the state and local tax deduction, which hits people in New York, New Jersey, California, especially, who used to be able to deduct their state taxes against federal. And now that's capped, as well as property taxes being capped. And so it's important that everyone understand this, because this is one reason why people set up corporations for their investing. That way, if they get their crypto stolen, the corporation can do its own tax return and take it as a deduction. There are a couple other things that can be done. If you've had crypto stolen or hacked and you didn't have a corporation set up for your trading or an LLC, come and talk to us and we'll see about the specific situation and see what's possible and see if it could be a property held for investment type deduction. But essentially, I think it's important just to let people know, if you have a ton of money out there in crypto, especially people mining crypto, bringing in all this crypto, that mining income, you still have to pay taxes on, even if it gets stolen, and then the loss would not be deductible. So some people are taking risk in the crypto space without even realizing it. So we're trying to get the word out about casualty losses not being allowed for individuals at this time after 2018. Okay, so, and again, another thing about a worthless security is that it's about the cost basis you paid. So if I traded one Bitcoin back in December 2017, when it was worth 19,000, I bought some ICO token, X token, whatever it is. I traded one Bitcoin. I got 100,000 of them. The cost basis of that, let's just say the Bitcoin was worth 19,000 at that time. So I reported a sale of one Bitcoin worth 19,000. Now that's the cost basis of my X token. Now X token goes bankrupt sometime in 2019. So I can write it off at the end of 2019. It would be like a sale of $0, a cost basis of 19,000. So a loss of 19,000. Your loss is equal to the cost basis, not to the max market value. I know some people have said, oh, but at one point it was worth this much. Shouldn't I be able to write off all of the amount that it was ever worth? And no, that's not how it works. You can only write off the cost basis. And typically in these type of things, it's like a worst of both worlds type situation. With when you're donating crypto, when you're losing crypto, it's the lower of the market value or the cost basis. Um, and and so that brings us to donating crypto. I'm just going to touch on this briefly because it's a pretty complicated area. But donating long-term capital gain, donating crypto that you've held for over a year has advantages in terms of being fully deductible. And so basically, it's usually better to donate crypto that you've held for over a year. Depending on how much you bought the crypto for, whether you hold it at a gain or a loss, you should really think about the tax consequences before picking which crypto to donate. So in other words, if you're going to donate to an organization, your church, whatever it is, you're going to donate for Bitcoin, come talk to a tax professional for a little bit. We're happy to even just look at your data, free of charge, and just tell you, all right, if you donate these 2 Bitcoin, you're only going to be able to deduct, this amount of money because they've gone down in value. So you're actually throwing away money because you paid more for them than they're worth, and you've only held them for a year. So really thinking about the crypto that you donate can create a lot more value for you as the donor, and it's a great thing to do for an entity that you're trying to support, especially when the world is so crazy right now, and there's so many causes out there and so many people struggling. I know a lot of people want to donate, want to help out, and so we just want to make sure that people do it in a smart, the most tax advantage way possible. We're all about personal finance skills at Token Tax, as a lot of you know, and so this is just a continuation of that. If you're donating crypto, there are advantageous ways to do it, and there are disadvantages. There are problematic ways to do it. So please check with a tax professional before you do it, or at least just come talk to us or send us a question here. We could do a special webinar just about donations once the tax rush finishes up, going through July 15th. Okay, we've got a couple more questions from Twitter and also in the webinar. Okay, so Avril asked, if you did not file crypto taxes for 2017, 2018, can you still file for 2019? So the answer is every year is individual. And so you need to file for 2019 regardless of what you did in the past. But if you had sales in 2017 and 2018, you need to go back and you need to amend for those returns. So then comes an issue where, well, what if it's not material? What if I only had $8 in gains and losses? It's a little more of a gray area. Technically, you should report it. If you only have losses, you still should have filed it. For one, you'll get money back from the IRS. And so you have 3 years from when that original tax return should have been filed to file and get your refund back from the IRS. So if you lost money in crypto, you want to go back and file. Technically, the answer is every year you had taxable events, you need to file. If your tax bill actually goes down, in a worst case scenario, you're getting audited and then you'd show the IRS, hey, you actually owe me money. Obviously, you want to avoid that. But so the short answer to your question is every year needs to be filed on their own tax return. And unfortunately, we can't just file 2019 and include 3 years of past data. It would actually make everyone's life a lot easier. But the IRS is very clear about this. Taxable events need to be reported in the year they happen. Now, there's one thing that people get really confused about. Oh, I just bought crypto on Coinbase in 2016, 2017. You literally just bought Bitcoin and Ethereum with dollars. You did not trade even once crypto to crypto. You're just buying crypto here and there whenever you pop on the app or the Square Cash app. That does not have to be reported. Buying crypto with dollars does not have to be reported. But everything else with crypto does. If you sold it, like we said, for dollars, sold it for crypto, spent it, you do have to report it. If you transferred it from one wallet to another, I know some other crypto tax software accidentally mark that as a taxable event incorrectly. And so a lot of people that we've seen, we've helped amend their taxes because they overpaid their taxes because some default software is doing that, including the Coinbase tax reports. They were showing withdrawals like from your Coinbase to your Binance account as a taxable event. Now that's not correct. So you need to make sure you're reporting just the correct transactions. But yeah, Avril, you need to amend 2017 and 2018. Again, there is a materiality kind of a buffer area. I don't think, I'm not the IRS, but I don't think you're going to get in a huge amount of trouble if you, had $100 loss that you didn't report. That being said, now that you know how it works, now that you're aware that taxes should be filed, you should do your best to fill the years that actually have a meaningful amount, and certainly 2019 at the very least. But we almost always suggest that people amend the prior years just to be in compliance, especially if it was any amount of meaningful dollars. So Spiros asked, is the suspended 10% fee for taking money out of your IRA only for 2020? What if I took money out of my IRA in January 2019? Okay, Spiros, so this is a great question. IRAs are pretty complicated in and of themselves, but if you took it out in January 2019, that won't be related to the pandemic. So the pandemic, the PUA, the way that a lot of you who are unemployed are getting $600 extra per week from the federal government. Quick PSA to those of you who are unemployed and still haven't filed for whatever reason. It's crazy times out there. I know a lot of people have pride about not wanting to take something from the government, but if you really have lost your job, including self-employed people, I really suggest that you learn about how it works and file. Often you can even do it retroactively for a certain amount of time. Some people are still trying to get unemployment claims filed on state portals. But setting that aside for a second, the IRA suspension, so you don't have to pay the 10% penalty, Spiros, if you took that money out for a number of qualified reasons, including any education expense, medical expense, it can be buying a first home. So take a look at what you spent money on during the year. And let's say you had a big medical bill for a daughter, for yourself, whatever, and it's more than the money you took out of your IRA. Theoretically, you should be able to avoid that 10% penalty because you took the money out and it went to medical bills. Or, if you had other hardships, if you were in a catastrophe zone or a federally declared disaster area for something other than the pandemic, like in 2019, people in California took money out during the wildfires, and that would be another way to avoid the 10% penalty. But it doesn't retroactively, if you just took it out for like investing, for whatever you needed it for, or to buy a car, the pandemic waiver, the 10% waiver, doesn't retroactively go back to the money that you took out. But there are things you can do depending on what you spent money on, is what I'll say. And right now, really the best thing to do is, it's called taking a loan. So if you've got $50,000 in your IRA and you're self-employed, whatever, your business is struggling, like a lot of businesses, you're shut down, you need to still pay some bills or whatever, you need to still pay your rent, you can take a loan from your IRA to yourself, use it for your business, or contribute that money to your business, and then your business can pay it back to you. You can pay it back to the IRA within 3 years with some interest, calculated interest that you're paying to yourself. But that way you don't destroy value. You don't have to pay you don't have to pay any taxes. You don't have to pay that 10% penalty for early withdrawal. You don't have to take a bank loan and pay fees on that and interest. So it's a really cool opportunity for people who are, ahead of, thinking ahead, saving money for retirement. Now they need it for something really important, an unprecedented, health crisis, as well as all these other situations going on. So many businesses are closed down or damaged or having problems. And so there are ways to get money out without paying big fees, penalties, taxes. So come talk to us if you're in a situation like this. We're happy to have our accountants and myself help you figure out your situation. Okay. So let's see some other questions. What exchanges are supported? So Token Tax supports every exchange. We probably have, I'd have to check with that, maybe like 170 wallets, exchanges, random, websites that help you reallocate your portfolio. Basically, entities in crypto who give you transaction data. We support maybe 170 of those automatically, and that just means you get your CSV or you get an API key, you put it in, and all the data goes in automatically, and your gains and losses calculate automatically. Sometimes a new exchange comes up, or if you use some platform that doesn't give you transaction data, so you keep track of it yourself, we have a template. You can get your data in, and it will go in automatically if it's put in that template. But also, we can help you format your data. If you're not as good with Excel, you're not as good with computers, we can help you get your data in from any exchange. Basically, we have accountants, crypto tax reconciliation specialists, experts in crypto tax and Excel modeling, Excel wizards, who can get your data, help you figure out the tax implications, and help you get the transactions into your token tax account. And so that's what we're here for on Intercom. And that's kind of the difference in our self-service software that's just connect your Coinbase and your Binance APIs all the way up to our more higher service packages or full filing services where you actually have our CPA Andrew, EA, tax experts beyond just crypto as well, filing returns for maybe 30 years of experience now, and so we're ready for all your full filing questions as well. And we take the same lens of, as people are familiar with our minimization algorithm, with the way that we've helped people understand the rules with crypto taxes and realistically delay paying taxes or save a lot of money in the short run, or help convert short-term capital gains that are taxed at 50% into long-term capital gains taxed at 25%. By helping them understand accounting methods, how to track their cost basis. And we take the same view, and we see your entire tax return through that same lens. Like I mentioned, maxing out IRAs, using your IRAs as a cost-free, an interest-free loan, or like a way to fund yourself during these crazy times. And we help you figure out, all right, well, you're using this part of your house as a home office right now, you're self-employed. There's a lot of things you can do. Again, an ounce of prevention saves a pound of cure. So coming to talk to us before the end of the year, I wish I could show, not sure if Devin can throw it up, but our tax loss harvesting dashboard. It's a way that crypto's been doing really well. We could get into that. The Fed, has printed trillions of dollars. Federal monetary policy for countries across the globe is following suit. Trillions of dollars are just being poured into the monetary system, ostensibly to prevent deflation, to prevent major economic damage as so many industries and places shut down. But one byproduct of that seems to be that the stock market, is rocketing up. The NASDAQ just hit another record high several months into the pandemic, which is pretty amazing. And crypto prices have gone up a lot from their trough back in March, when they dipped down to even sub 5,000, and they have almost doubled since then. And so that's been really bullish for the community and for the people that really look at Bitcoin as digital gold at the very minimum. Crypto has so much disruptive potential across industries, smart contracts, remittances from with Ripple and Lumen, the original ones a few years ago. And Bitcoin has so much potential as a platform, but especially as digital gold hypothesis. So I think a lot of people were disappointed when it started crashing with all the other assets in March. And so seeing it bounce back in April, May, June has been really heartening, really reassuring that people knew what they were talking about when they said, look, if there's trillions of dollars, $15 trillion of gold right now, Bitcoin has all the properties of gold. It doesn't produce income in its natural state, although you can use programs, you can use DeFi protocols, which we can talk about. And Token Tax is trying to be the DeFi expert for crypto taxes. We've put a lot of resources into understanding it. Our team loves to use DeFi platforms. We're going to do a webinar with one of our newest team members soon to show people how to do your first DeFi trade, show you some of the platforms, and it's probably going to be a new product that we're offering in case anyone is interested, basically helping people learn how to put their crypto onto DeFi platforms and earn interest on the crypto they have. But again, even setting that aside, gold doesn't produce a return. If Bitcoin doesn't either, it's cheaper to store, easier to transit around the world with it or to move around with it. You don't have to wheel a suitcase full of gold, while all these borders are closed. With crypto, with Bitcoin, you can walk around with this value memorized in your head, or on a hardware wallet or things like that. And so seeing it hold its value during such an unprecedented, crazy time has been really heartening, and I think extremely bullish to the long-term potential of people seeing why it has value. So that's been a silver lining of what's been going on for us in the crypto space. Okay, so let me check what other questions might have come in. Again, One other thing about IRAs, I see another IRA question. You have till July 15th to do your IRA this year. So if you have money that you could put into an IRA, you can reduce your 29 tax bill even more. The deadline isn't April 15th like usual. It's actually July 15th. And again, like I said, we're a full service accounting firm. Happy to help. Companies out there that have been impacted by this. We're working with some venues in Brooklyn, places, even restaurants, places that haven't started taking crypto or anything like that, just to understand what are the options. We're all in this together. New York City has been hit extremely hard. A lot of places are still closed. They just delayed again, reopening health clubs and things like that. And they're doing it for public safety reasons, but obviously that doesn't help businesses out there pay the bills. And so not just looking at crypto taxes, but there are a lot of things that you can apply for. There are economic injury, disaster loans. There are a lot of things that have been done, but it's typical government. You have to learn how to jump through all the hoops, navigate the red tape in order to get benefits that realistically should be going to your businesses in many cases, but often aren't because it's just too difficult to learn how to do this. So again, we're happy to help any business figure this out. We know accountants are expensive, and attorneys are even more so. So we really just want to do what we can. We've been working with first responders, helping them get their tax returns done, at a discounted rate. If anyone out there falls into that category, but yeah, hopefully everyone's able to stay safe. I know we have just a few more minutes. So if anyone has any other questions, otherwise I can go back to the ones that were already submitted. Okay, biggest ways to move the needle on your tax bill. Someone asked about, okay, if I have short-term holdings and long-term holdings, what are the tax differences going to be? And this is the biggest way. This is the biggest free lunch in taxes. So those of you who are familiar with FIFO, LIFO, minimization algorithm, accounting methods let you track which Bitcoin you're selling or which Google shares you're selling. It's probably easier to think about it from a stock perspective. But if you buy Apple stock and you rebuy more shares every quarter, you get a dividend, you buy more shares, and you just keep compounding more shares of Apple, you go to sell some of them. If you do FIFO accounting method, you're going to sell the oldest ones. If you do LIFO, you're going to sell the newest ones. So the problem with LIFO, you're probably using the highest price ones, but they're short-term capital gains. So if the stock's up 30% in the last 2 months because of this run-up since March, well, you're going to have to pay short-term capital gains taxes, which I mentioned go up to like 55% for some people in New York, California. So theoretically, if you sell FIFO, use FIFO accounting method, you're going to use the oldest Apple shares. So at least your gain will be long-term. And there's an optimized way, which is how I've always traded my own stocks, which is let's look at all of the times I bought Apple. Let's ignore the ones that have short-term capital gains. But look, randomly Apple prices went up a while ago. I actually hold some at a loss. I'm going to sell those first. Then I'm going to sell these other Apple shares that I've held for over a year, but that I paid the most for at that time out of all the long-term holdings. So my gain is only a small amount, and it's a long-term capital gain. So you have that. And so the thing about accounting method is it just changes the timing of gains, not the magnitude. So what you made in crypto, you made. And that's why different accounting methods are allowed for stocks, like your total gains and losses. Once you sell all your crypto, all your stocks, whatever it is, there's no difference in the method you took. But the mix of short-term capital gains to long-term capital gains has changed. And probably you've cut your tax bill, in half or down 40%. So that is really the biggest free lunch in taxes, is figuring out how to get all your gains to be long-term capital gains. And so a lot of you out there lost money in 2018. You might have a big loss rolling forward. Long-term capital losses and short-term capital losses can both wipe out short-term capital gains. First, you set your long-term capital gains and long-term capital losses together, then your short-term capital gains and short-term capital losses. And if there's a net difference in those two, like if you had a long-term capital gain and a short-term capital loss, those two offset each other. And so the holy grail is really using a short-term capital loss, a long-term capital loss to wipe out a short-term capital gain. So what's happening right now when some projects, some cryptocurrencies have shot up and people bought them a few months ago, they really like the token at $2. Now it's at $4. But from a tax perspective, they don't want to sell it when they only had it for 3 months. But if they have losses on other holdings of their crypto, like they bought ETH at a bad time 2 years ago, whatever it is, you could capture those losses to wipe out the gain. That's even though it's a short-term capital gain. Now, if your losses wipe it out, you don't owe any taxes. So this is a big thing, a big opportunity. And this is what our tax loss harvesting tools are, or our tax loss harvesting sessions with our crypto tax reconciliation experts. We take your portfolio, we look at these opportunities, we hear what you care about in your investment portfolio or what you want to buy or the crypto projects you're most certain of. And then we help you navigate an investment path to minimize your taxes by, selling the things you want to get rid of in the most efficient way possible. So that's a big tax loss harvesting, tax loss opportunity, investment opportunity session and plans that we do, probably more so in the second half of the year, because the US uses an arbitrary calendar year system for taxes. So doing it at the end of the year is typically the way to go. But if you have a project that shot up in value, you're kind of uncertain, you think it's going to go down, come talk to us now. We can make this plan so you don't have to hold it while it drops if you think the run up was too much. I've had a conversation about this a few times. I don't want to say the project, but obviously we've all seen some projects shoot up in the past couple of weeks, and people are looking to say, hey, maybe the excitement is overdone. I'd like to take some off the table. Okay, let's see. One other question came in. Okay, we already answered that. Any other questions? Oh, okay. So, is there a way to determine cost basis for coin swaps if you don't have a record of any of those swaps? And so the short answer is yes, we can come up with a way. We have a really good blog post about this. Maybe Devin I can throw it in the chat. But there's something called making synthetic trades. So I'll give you a simple example. I know we're kind of running out of time, but for Mt. Gox, a lot of people bought Bitcoin on Mt. Gox, got it off, they had it on their wallet, they went, and then in 2017, they started trading that Bitcoin for other cryptocurrencies that emerged that year. Now, when they put all their data into token tax, it looked like they sold a lot of Bitcoin, had zero cost basis for it. So they had big gains in excess of what they actually should have been because they didn't have their Mt. Gox purchase data. So what we could do is say, all right, we know they bought it in this period in 2013. They took it off. We see they transferred it out June 30th, 2013. So we know the first 6 months of the year is when it was bought. They only created the account at the beginning of 2013. So what we do is we look in that window, what was the lowest price Bitcoin traded at on Mt. Gox? Because we know that the client had to pay at least that much. So let's just say the lowest price it ever was, that whole first half of the year right here was $500. So we use that. They paid at least $500 per Bitcoin. And so then we can make a synthetic trade. And they did that trade at the latest June 29th, 2013. Still way over 1 year ago. So we'll get the long-term capital gain treatment, but now we've been as conservative as possible recreating those trades, creating synthetic trades in a way that the IRS will look upon very favorably because it was conservative. It minimized the amount of taxes that are shielded because they probably paid more, right? They probably paid more than the minimum. Maybe they paid $530. But so if the IRS comes and audits our client or requests more information, we can say, well, we could go start digging across the blockchain. We can see when those transactions happen. But at the very minimum, you're going to end up owing our client more money because we've already used the most conservative price. And so that's a simple example, but you can do the same thing for any other trade based on the parameters of what you know. Oh, I traded on Binance at this time. I then was hacked. I lost access to my account, or Binance took away my access. I don't have the data, but I know that the trades were made within this window, and it was a trade of ETH for these two coins. And so we can work backward. And this is what our VIP offering, this is one of the things we do with the VIP offering, because this is very time consuming, very time intensive, takes an accountant to go back and be able to say, all right, what were the prices of each coin? What was the minimum ratio? Because we need to do it in as a conservative of a way as possible. But you're exactly right. If you lost this data, potentially you're overpaying your taxes. And so it actually pays for itself many times, even though the VIP service is $2,000. You know, for people that lost thousands of dollars of cost basis, you know, it ends up creating huge amounts of value. And then you make sure that it's done correctly in a way that will stand up to an IRS audit. And the VIP also includes Irs Audit Assistance. So if you get audited, we hold your hand through the whole process. We navigate the communications, and we are basically like a shield between you and the IRS, answering all their questions about the crypto data, the metadata about the crypto, how we calculated the gains and losses, where we got all the numbers, where we got the prices. We use the same price database that they use. So there's no consistency issues there. And so these are some of the big benefits of the VIP plan that we have. But if you know, I know that it can cost a lot of money. If you're a much smaller scale investor, you can try to do the same thing on your own. Just keep in mind the principle of conservatism. You need to use the minimum price that can be justified in a window. You can't just say, well, the average price of Bitcoin in 2019 was 11,000. I'm just going to use that as my price because I probably, you know, I bought some higher, I bought some lower. No, that's not fine. You can't just use the average price. You need to use like a minimum price in a window. Okay. 1 minute left. Any other questions? Doesn't look like anymore. Again, come to tokentax.co, intercom on the bottom right. Email me. You can email us at Zac, Z-A-C, at tokentax.co or support@tokentax.co. Right now it's been busy. Please don't procrastinate too much. We're getting a lot of people showing up, but the sooner the better. July 15th is the deadline at the very least to file your tax return or file an extension. File your extension so you don't get hit with that 5% penalty, and then figure out what you owe. Filing an extension is not just like click a button. You have to actually tell the IRS, hey, I believe I owe this much, or I'm owed an estimated refund of this, but I'm not going to file until later. And then you have till October 15th. So the big takeaway here is get something done by July 15th, whether it's an extension or not. Do not show up on July 15th or July 14th, please, and say, hey, I need an extension, because we actually need your tax data. We need to figure out what you owe. There's no such thing as just like a blank extension to the IRS. They could deny that. So please try to come earlier. Everyone enjoy July 4th, and please stay safe out there. It's good to see some familiar faces in this chat, and hope everyone's doing all right. And yeah, if you want to sign up, tokentax.co, come to Intercom, tokentax.co, click pricing. You can see our packages. If you're confused about which one you qualify for, Averill, please just come and talk to us on Intercom on the bottom right, or email me. I'll connect you with Devin, who's running our sales right now. All right, thanks for the questions, guys. Have a nice day.